Welcome to All About Money on HK IBC. I'm Chloe Feng. It was an important week for financial markets, starting on Monday with China's Politburo meeting on economic assessment, and moving on to the interest rate decisions by the central banks in the United States, the Eurozone, and in Japan. Chinese stocks rallied on a dovish Politburo announcement, signaling support for the beleaguered property sector. But can the momentum be sustained? Meanwhile, there was also caution with the U.S. Federal Reserve poised to hike interest rates to a 22-year high. So how do all these pieces of the jigsaw puzzle fit together? Let's get some clues from Brooke Silvers, Chief Investment Officer at Kaiyuan Capital in Hong Kong. So, Brooke, it's great to have you today.
It's great to be here.
Let's firstly talk about the Beijing's Politburo meeting. What is your key takeaways from this meeting? Do you think this meeting really signaled more measures to come along the way?
I was actually unimpressed with the meeting. I'm not quite sure why the market reacts the way it does. I think the meeting didn't announce very much. If it decided much, it certainly didn't do so publicly. What I would say is that there have been quite a few, I think, intentional efforts to prop up market sentiment, and this meeting certainly fits in that mold. Trying to get people to feel better about the Chinese economy and Chinese financial markets. But ultimately, the only way to do that is through specific policy enactment and not sort of generic pronouncement.
I know there have been quite several different kind of announcements on different sectors and different aspects as well. What will be the key messages you received from Beijing at least? I know maybe you didn't anticipate much or you didn't see tangible actions, but what are the key messages that impressed you or not at all?
I was impressed by the fact that not much was actually announced. You know, everyone is waiting for major stimulus announcements. I'm not sure that's really going to come, but what we received was more of a statement of intent to support markets, private markets, real estate markets. But a statement of intent to support is different than here's a specific policy that will support.
Right. There are many analysts and economists, though, think that the measures seems to be quite dovish, and especially on the property sector, because this is for the first time in a very long time that President Xi Jinping's mantra, housing is for living in, not for speculation. It was deleted from the latest statements, so it somehow signals the hope that maybe there will be more measures to boost up this property sector. Do you think this could be the case? Do you see there could be more tangible measures for the property sector?
The omission of that phrase was positive, but it also just creates a feeling rather than a specific proposition. The absence of the phrase that triggered the crackdown that imploded the real estate sector's prospects is by itself not really something that that warrants celebration. What it leaves us with is a real estate sector where the fundamental profit model has evolved from the period before, let's say, 3 red lines were first announced. And at this point, the old system whereby there was massive easy credit to developers to participate in inflated local auctions to feed kind of manic local speculators, that real estate model is gone and isn't coming back. So Beijing will have to come to grips with the fact that there's a new real estate profit model, and it has to figure out what that's going to be. And once it does that, we can get beyond the problem and hopefully move past it.
But now that some people are anticipating that, for example, the purchase restrictions in the Tier 1 cities, the biggest cities in China, could be lifted so that maybe there could be more purchases and demand being propped up. Do you think this could be possible later on? And also, authorities are signaling that they want to have more urban village renovation and construction in order to boost demand. Will this help?
I think we will see a bunch of policies in that vein. But in my view, there's no combination of small interest rate cuts, RRR adjustments, or mortgage regulation tweaks that we can do that can revive the real estate sector. The sector, in my view, needs a complete restructuring. And Beijing has been reluctant to do that because it looks like it would be both expensive and painful. But once you accept that reality, we can then start to move on to the next phase where I think we can eventually get back to a real estate sector that may be healthy, but will likely be smaller and unfortunately less profitable.
What kind of a fundamental restructuring could be ideal from your point of view?
Well, look, it certainly, the sector as it stands right now is too large and too indebted. There's a tremendous mismatch between developer balance sheets and developer forward-looking income statements. The businesses just can't support the debt loads that they've been allowed to accumulate. So what's going to happen? Somehow that debt is going to have to be restructured. Who bears the brunt of that pain and how it gets dispersed? Those will be very difficult questions, and it can only happen if Beijing takes the lead and forces a solution. And I expect at some point, if the property sector rebound doesn't come in the way Beijing was hoping, at some point they're going to have to go down that route. And I expect that'll happen sooner rather than later.
So maybe some bailout measures from Beijing, from the central government to certain developers?
There will be, but it won't and can't cover everyone. So there will be some winners, but there will definitely be some losers. And that pain will be difficult for many people.
One thing, though, Beijing authorities did acknowledge that there is a structural change in the demand and supply situations in different kind of regions, and the situation probably varies from provinces to provinces.
Right.
And they actually want to have the local governments to issue specific measures that cater to local situation.
That makes sense, but here's the problem. Prior to our current situation, real estate was generating perhaps a third of GDP growth in China. Now that's imploded. Where's that growth going to come from? We don't know. Now, a typical driver that Beijing has been using with great effect for a long time has been to allow significant access to credit to LGFVs, which now, on the whole, are often quite insolvent. So we can't keep going to the local governments and asking them to finance growth via debt. They simply can't bear the debt anymore. So essentially, policymakers have painted themselves into a corner now, which means tougher decisions will have to be made.
I want to point out one of the property developers, that is Chinese Wandas. It has raised $314 million through the partial sale of a subsidiary over the weekend, and it appears to have used the proceeds to repay a $400 million bond, which matured on Sunday. And in a Hong Kong Stock Exchange filing, Wandas said it had agreed to sell a 49% stake in a unit of Beijing Wandas Cultural Industry Group to China Ruyi Holdings for 2.26 billion yuan. And several direct investors have confirmed that the bond had been paid. Do you think this last minute, realization in its debt payments could signal a change in its outlook as well? And does that also eliminate a big hurdle that is faced in the high yield market?
Well, I was pleasantly surprised that they made the payment. I didn't expect that it would happen, and I think a lot of my colleagues probably joined me in that sentiment. So kudos to Wandas for having made that payment. I also would wonder why they only sold a minority stake. I think they should be more in fire sale mode, but I'm not in charge at Wandas. What I can say is that we may have escaped a small problem this weekend, but it doesn't really tell us what we're going to do going forward. If Wandas doesn't get Shenzhen IPO approval before the end of the year, I don't see any way they can meet the financial obligations that will then, be upon them. So they'd be in quite a bit of trouble come the end of the year, and there's no indication that their fourth or fifth attempt at IPO approval will be any more successful than their previous attempts. What we do know is that the entire China dollar bond market is very tenuous. Not only does it have a terrible recent track record with so many defaults, but the maturity schedule over the next year, over the next 12 months, is daunting beyond belief, and I don't think there's any way that the sector can meet all of those obligations. So what's going to happen? Everyone needs a solution. If there's no solution, you will continue to significantly alienate an important investor group. And when important investor groups feel put upon, they tend not to reinvest. And now that's become a problem with a lessening of foreign investment interest as China tries to pull out of its recent downturn.
Right, and in the meantime, we also have the Evergrande's debt restructuring plan that is ongoing, but the outlook remains very gloomy for now. But following the Beijing's announcement, we've seen the equity market rebounded, largely boosted by the property sectors. But just how sustainable can this kind of like rally last from your point of view?
Look, the longevity of the rally will really depend upon how Beijing starts to handle some of the underlying economic issues. But as of right now, we've seen no indication that they're really ready to make some hard decisions and make some tough announcements. So up until this point, we've seen some rather happy-sounding generic statements of support, and that won't be enough to keep the rally going. So if it were my portfolio, I'd be betting against the current rally.
All right, so we're now waiting for more concrete actions from Beijing. All right, so thank you very much for your thoughts, bro. We will take a short break. But coming up next, we'll talk more about the economic outlook in China as well as in the US. So do stay tuned. Welcome back to All About Money on HKIBC. I'm Chloe Feng. Joining us today is Brooke Silvers, Chief Investment Officer at Kaiyuan Capital in Hong Kong, to discuss the latest major events affecting the financial markets. So welcome, Brooke. Earlier, we have talked about China's property sector and the latest Beijing Politburo meeting. Now, I also want to talk about the private sector because earlier the policymakers indeed showcased that they're engaging more closely with this sector and meeting with various enterprises executives to know their demands. And last week, we've seen the 31-point plan that was issued to support the private economy. But you seem to be rather skeptical over such moves, citing there's no concrete measures. But from your point of view, what sort of measures will be really serving like a turning point to attract the foreign investment and also to expand demand to prop up this private economy?
Look, I appreciate that Beijing is going out of its way to try and attract foreign investment. And they've enlisted a host of executives who have all been front and center trying to tell investment execs like myself that we're welcome in China and we should bring our checkbooks and our big ideas.
So you attended some of the meetings as well?
No, my email address must not have been working because I did not receive my invitation.
In the second half, you will.
to the main meeting that just happened. However, what I would say is that a lot of the efforts aren't really addressing the concerns of foreign investors. Foreign investors are skeptical of China, at least more so than they have been for quite a few years, for two main reasons. The first one has to do with what is largely called investability. There are larger issues afoot now, be they the security law, the data privacy issues, the tech war, regulatory risk. These are issues that are larger than normal macroeconomic issues, and I don't think we can look for significant changes or solutions in the near term. But without them, many foreign investors start to wonder if China is sufficiently investable. So that's a continuing worry. There's also the issue of growth. And now that we've perhaps zeroed out real estate developer contribution to China GDP, that's a third off the top. And if LGFVs are overly indebted and can't really drive infrastructure spending through new debt as they had in the past, where's the growth going to come from? Well, in the old days, if you had massive growth rates, people were willing to take more risk. Today, if we've settled into a more normal, more developed country growth pattern, if the model has changed in that way, the upside is lower, and people are much more focused on the risks they may have to bear in order to get a piece of that growth. And the equation simply looks less attractive. So 2 issues. We need to be convinced in terms of investability. And I think by and large, many of us are prepared to be convinced. We're not implacably against the idea of investing in China. We just need to be convinced that it's a system whereby we can still, with some security, invest, earn a reasonable return, and repatriate that return in good time. Right now, that's a question mark. We need investability reassurance, and we need to understand the larger growth model. What's going to replace the previous era's growth in driving this economy forward? And right now, that's also a question mark.
I think now Beijing is also sort of at a crossroad to determine how it should go forward with the current situation, isn't it? So maybe authorities are also thinking what are the next steps to how to clarify some of the sectors or the returns. The national development...
That's an excellent point. I would add that the reason that there haven't been policy pronouncements is not because somewhere there's a lazy official or an official who's not smart. That's not the case at all. It's because smart people are busily trying to figure out what they believe the best path to be, but they haven't quite gotten there yet.
So they're studying.
Right.
Examining.
So it may happen soon, but then again, it may not. We don't know.
Yeah, because the old playbooks is now apparently not going to be, like, at least be feasible or efficient in the short term.
That's right.
With the situation. But I want to point out that the National Economic Planner, the NDRC, also released a white list on Monday, citing it has identified a series of industries and key state projects now open to private investments. The sectors included the transport, water, clean energy, new infrastructure, advanced manufacturing, and modern mechanized agriculture. Would any of these sectors be one of your interests?
Look, in general, I certainly like those sectors, and I like them in the Chinese environment. But the fact that I like those opportunities doesn't negate the larger risks that that investors still fear. So we still can't get caught up in geopolitical tensions. We don't want to get caught up in a tech war. We can't face regulatory risk of the sort that we've seen. So much of this is problematic. So even though I like the sectors, and I think NDRC is probably doing an excellent job of selecting those sectors.
And projects.
But I still am reluctant to just jump in. It goes back to the investability issue.
All right, but for example, now the booming tech sector, let's say boosted by the artificial intelligence from the ChatGPT, and now that Beijing authorities are also encouraging the private companies to incorporate this kind of AI technology into its product practices, would you bet on the AI sector in China?
There are companies in Chinese tech and AI that I would love to own. However, that's ground zero for some of the concerns that foreign investors have. Imagine the risk of the unknown risk attendant to the U.S.-China relationship in terms of tech investing. That's just not something that many investors are willing to bet their careers or bonuses on. So I think that for most people, especially for people who aren't present locally and who don't have deep expertise, the allocation for Chinese tech and AI is probably close to zero.
All right. On another note, Beijing authorities are also identifying automobiles, electronic products as a key sector they want to prop up first. So they encourage the residents to expand their demand or consumption on these sort of sectors. Do you think these measures will be effective to really help boost demand as they hoped?
Boosting domestic demand has been a priority for the Chinese government since I can remember. It's not a new priority. It's a very, very long-standing priority.
Right.
The problem is it's very difficult to do. And a lot of people expected that there would be a tremendous bump in demand post-COVID, post-zero COVID. And that never really materialized. And right now, I just don't see it on the mainland. Mainland consumers are quite cautious right now. And I just don't think that that's going to change unless there's something dramatic that happens from the government to make people change their minds. So easier said than done.
All right, still have the high unemployment rate, and also the household savings are still surging instead of reducing. So it's rather difficult for now.
And the youth unemployment rate also impacts a crucial segment of society in terms of spending. In terms of consumer demand, you need the youthful segment of society to feel productive. And right now, that's an issue in China.
Before we wrap up, I want to know your thoughts on the U.S. economy as well, because now this is also a key, very important week for the rate development projections, and we're anticipating the U.S. Federal Reserve to issue another 25 basis point increases in its interest rates. Do you think this will be the last in a very long time? For example, by the end of the year, we will not see any other rate hikes. Do you think this could be possible?
Almost everyone expects 25 basis points this week. The market will be shocked if it's anything other than a 25 basis point increase. Going forward is when views start to diverge. Many people think this is it. We've hit the top. I personally think that inflation is not yet under control. It's probably stickier than we think, and I think there will be subsequent increases. Whether they come later this year or first quarter next year, it's still a bit hard to tell, but I would bet that we have more to go.
In the second half of this year, when do you anticipate that we could possibly see some rate cuts? For example, some economists are forecasting maybe we can see it in next March. Do you think this is also in line with your forecast?
Ordinarily, based purely on economics, I would say it would be a long time until we get to the point where we're cutting rates. I wouldn't foresee it at all in next year. However, next year is a U.S. presidential election. And the larger bureaucracy, I think, will want very much to re-elect the Democrats. And for that reason alone, I think it seems very likely that we'll see some rate cuts, especially towards the second half of next year.
So from your point of view, we're nowhere near at a point where we can declare victory against inflation. But last month, we did see the inflation rate in the U.S. dropped to 3%. That's quite impressive, isn't it?
Well, it's a big drop from our highs, but we're still hovering kind of twice our target rate. And I would note that we still see some inflation indicators bubbling through the economy, not to mention that the U.S. administration, I think, has been manipulating inflation to the low side by playing games with the Strategic Petroleum Reserve, which can't go on forever. So I think energy and housing in particular, in my view, will drive inflation forward still. I don't think we're through yet.
But are you more optimistic about the outlook for U.S. economy now that it shows much more resilience performance?
The resilience has been surprising. I, along with many others, expected that we would see a real recession before this point. But it looks like some of the massive stimulus that we put through the system is not quite over yet. If indeed we get to next year and we haven't hit a significant recession, if we start to get rate cuts in relation to the election, maybe the resilience will continue. But I am quite nervous about the U.S. economy.
All right, and over to the central bank's meeting in the Eurozone and also in Japan. What are your expectations in those meetings? And for example, in the Bank of Japan, do you think for now Japan's inflation is surging, is now actually higher than the U.S. inflation?
Right.
Do you think the Bank of Japan policymakers could, change its rates as well to cope with the inflation?
They're certainly not anxious to do that, but with inflation the way it is, and if the Fed raises this week and puts out a statement that makes us think that they are likely to raise again in the near future, that will create a lot of pressure in Japan to fall in line.
All right, thank you very much for your thoughts, Brooke.
Sure.
It's great to have you today. That's Brooke Silvers, Chief Investment Officer at Kaiyuan Capital in Hong Kong. And thank you for watching. All About Money will be back next Sunday night. Until the next time, please have a good night.